You wake up, check your bank account, and before you even spend a single rupee, a portion of your income already belongs to the government, deducted automatically, clean, invisible, unavoidable. But somewhere else, someone earns millions, sometimes billions, and legally pays almost nothing. No alarms, no fraud, no loopholes you can easily see. Just a system quietly doing exactly what it was designed to do. And the uncomfortable part is this isn't a glitch, it's the feature. Because the way billionaires make money is completely different from the way you do. And once you see that difference, it becomes impossible to unsee. Right now, this matters more than ever, because wealth inequality isn't just growing, it's accelerating. And the gap isn't just about how much people earn, it's about how differently that money gets treated the moment it exists. So let's start with something simple. You earn money through a salary. That's income, and income is taxed immediately. No escape, no delay. But billionaires don't really earn income the way you think. Their wealth comes from assets, stocks, companies, ownership. And here's the key distinction. Assets going up in value are not considered income. They're just gains on paper, and paper gains are not taxed. So if a billionaire owns shares worth $1 billion, and those shares double to $2 billion, they just became $1 billion richer, but on paper only. No sale, no tax, no event, nothing to trigger the system. And this is where it gets strange, because while you need to sell your time to live, billionaires don't need to sell their assets. They can hold them indefinitely, and as long as they don't sell, the tax system stays silent. But then the obvious question appears, how do they actually spend money if they're not selling assets? And this is where the system turns from simple to almost surreal. Instead of selling their assets and paying tax, they borrow against them. They go to banks and say, look, I own billions in stocks. Lend me money using this as collateral. And the bank agrees, because to the bank, lending to someone with billions is one of the safest bets in the world. So now the billionaire has cash, real spendable money, but it's not income, it's debt, and debt is not taxed. So think about what just happened. They got liquidity without creating a taxable event. They can buy houses, jets, fund lifestyles, all without triggering income tax. And here's the quiet irony. The richer they are, the easier and cheaper it is to borrow, meaning the system becomes more efficient the higher you go. And it doesn't stop there, because when assets are eventually sold, there are ways to minimize that tax too. Long-term capital gains are taxed at lower rates than regular income in many systems. And if structured carefully, even those can be deferred, reduced, or offset. And then comes one of the most overlooked mechanics, time. Because if a billionaire never sells and eventually passes those assets to heirs, many tax systems reset the value to current market price, meaning all those gains that were never taxed during their lifetime can effectively disappear from the tax record, wiped clean, as if they never existed. So the entire strategy becomes clear. Buy assets, hold them, borrow against them, and pass them on, never triggering the kind of taxation that applies to earned income. And suddenly, the idea that billionaires pay little tax isn't shocking, it's logical within the rules. But here's where the discomfort deepens, because this system wasn't secretly hacked. It was built this way originally to encourage investment, risk-taking, long-term growth. And in many ways, it worked. Economies expanded, companies scaled, innovation accelerated. But over time, something shifted, because when asset growth outpaces wage growth, and when tax treatment favors ownership over labor, the gap starts widening faster than the system can explain. And now you have a world where two people can generate the same economic value in completely different ways. One pays tax immediately, the other defers it indefinitely. One trades time, the other leverages ownership. And both are playing by the rules, but clearly not the same game. And this is where the narrative often gets simplified into good versus bad, rich versus poor. But the reality is more mechanical than moral. The tax system is built around events, not wealth. It taxes transactions, not potential. And billionaires are simply operating in a space where those taxable events rarely occur, which creates a strange paradox. The people with the most economic power often triggered a least taxable activity relative to their wealth growth. And when you zoom out, the implications start to stack up. Governments rely heavily on tax revenue, especially from income. So when more wealth shifts into forms that aren't regularly taxed, pressure increases elsewhere, often on salaries, consumption, or smaller businesses. And over time, that can reshape entire economies, not through sudden collapse, but through slow, almost invisible redistribution of burden. And yet, changing this system isn't simple, because every rule that limits tax avoidance also risks slowing investment, reducing liquidity, or triggering unintended consequences in markets that are deeply interconnected. So policymakers walk a tightrope, trying to balance fairness with growth, stability with incentive. And in that balancing act, the current system persists, not perfect, not broken enough to force change, just stable enough to continue. Which brings us back to the uncomfortable truth you started with. It's not that billionaires found a secret way to escape taxes, it's that the system rewards the way they earn money in the first place. And once you understand that, the real question isn't why they pay so little, it's whether a system built for a different era can still make sense in a world where wealth no longer behaves the way it used to. And if it doesn't, what happens next when more people begin to notice the difference?